What is up, trading family? Welcome back to the Trading Floor Weekly Review, the Saturday deep dive, where we don't just read you the scoreboard. We crack open the playbook and figure out what the market was actually trying to tell us. The crew is here, the coffee is nuclear strength, and this week was an absolute cinema. We got peace trades getting priced but not signed. We got a single stock ripping 21%. We got software putting up its best month since 2001. And we got gold sending a signal that almost nobody is talking about. If you're listening to this on a Saturday morning, you're already sharper than 90% of the street. Let's get into it.
Week of May 25th to May 29th. Let's set the numbers so everyone knows where we closed on Friday. The SPY, ticker SPY, came in at $755.95, up 0.17% on the week. The Q's, Quest, closed at $737.86, up 0.30%. The VIX got chopped down nearly 9% on the week. Oil got smoked. Brent crude had its biggest monthly loss in 6 years, down 7% on the week. That is not a casual move. That is a macro statement. But here's the tension that defined everything this week. The market priced an Iran peace deal that hasn't been signed. Trump met with Iran, went to the Situation Room, and came out without a final determination. The market decided the outcome anyway and ran with it. That's the bet of the week, and that's the risk heading into next week. Quick reminder to everyone listening, nothing we say here is financial advice. We're just talking through what we saw. Do your own research before making any trading decisions.
And that's the spine of the whole show right there. The market picked a lane. After weeks of chopping around with tariffs and Iran headlines, and nobody knowing which way to lean. This week, the market stood up and said, I'm going with the optimistic scenario. And it didn't whisper it, it shouted. Oil down 7%. VIX down 9%. Quest up nearly 3% on the week before Friday's little give back. Tech leading the charge. Software having its best month since 2001. That is a decisive, loud vote. But here's the part I want to stress before we go any deeper. The market voted on a deal that is not done. The meeting happened. The handshake didn't. And if we get headlines next week that talks are stalling, that oil drop reverses, that VIX compression reverses, and suddenly the entire thesis driving this rotation gets tested in real time. This is not a victory lap yet. This is a bet. A big one. And we're going to spend this whole show unpacking what that means. TB, you want to set up the PCE piece? Because that's where this peace trade gets real for the Fed.
Let's go there. The Wall Street Journal had a piece this week. That, I think, is the single most important macro read for anyone trying to understand where we are. Core PCE, the Personal Consumption Expenditures Index, the Fed's preferred inflation gauge. It is still running above target, and the Iran disruption channel is a specific, identifiable reason why. Higher oil from the conflict feeds into transportation costs, which bleeds into core goods. It's a transmission mechanism. It's not a huge number in isolation, but it's enough to keep the Federal Reserve from cutting rates. If the Iran deal actually gets signed, that war premium evaporates. Oil stays down or goes lower. PCE eases, and suddenly the inflation picture looks different enough that the rate cut conversation can restart. If the deal stalls or falls apart, we stay stuck with sticky inflation and no path to cuts. And eventually, the market has to price that disappointment out.
And that leads me to the thing I think is the most underdiscussed story of the entire week. Gold. Look at what gold did. Or more accurately, look at what gold didn't do. Oil crashed 7%. Equities ripped. VIX collapsed. Risk assets across the board were screaming that everything is fine. The peace premium is unwinding. Let's party. And gold? Gold was basically flat on the week, down just 0.27%. If this was a clean risk on week, with a signed peace deal sealed and delivered, gold should have gotten sold hard. 3% down. It did not move. That tells me there is a bid underneath gold that does not believe this narrative is finished. Someone is hedging. Institutions, maybe sovereign funds, maybe the same smart money that was selling oil into this rally. Someone is holding gold through this because They don't trust the peace trade yet.
That's the sharpest signal of the week, and I want to make sure it lands with everyone listening. We have a three-way divergence. The equity rally says peace is priced, done, move on. Gold flat says not convinced. The hedge is still on. And the PCE data still has the war premium baked into the numbers. 3 signals, 3 different messages. Something breaks next week. When you see divergences like that, they don't just hang around indefinitely, they resolve. And the resolution usually comes with a directional move.
Here's how I'm framing it. 2 paths. Path 1, the deal gets done. Oil stays down, the PCE war premium fades, the Fed rate cut path opens up, risk assets keep running. That's the bull case. Path 2, talk stall. Headlines turn negative. Oil reverses, VIX spikes, the peace trade unwinds, and suddenly you're watching June kick off with a gap down. 2 paths. We don't know which one yet. What we do know is the data we're watching. Oil, gold, VIX, and every headline coming out of the White House on Iran. That's the signal set, not conviction. Signal. All right, let's shift gears. TB, I want to go straight into the big individual story of the week because it deserves its own air. You held the Micron trade. Walk us through it from entry to where we are now. Not the brag, the system. How the decision points worked.
Yeah, let's do it properly. Micron Technology, ticker MU, closed Friday at $965.21, up 4.49% on the day and up 21% on the week. That is an extraordinary single-week move for a stock of this size. My entry was at $803. The thesis was not complicated. HBM, high bandwidth memory, is the bottleneck in the artificial intelligence infrastructure build-out. Everyone focuses on NVIDIA designing the chips, but if Micron and its competitors can't supply the high bandwidth memory those chips need, the whole pipeline stalls. That supply chain reality was underappreciated in the price when I entered. The technicals backed it up. Micron had been consolidating for weeks, then it broke out on volume. The system flagged it with a high prospective gain score, the volatility gate passed clean, and the entry triggered. Here's how the tier system worked through the week. First exit at around $867. I took 2 shares off the table. That's the system forcing me to bank profit early even when the thesis feels strong. Second partial at a similar level region. Third tier at around $841 after a retracement. Each tier exit locks in realized gains and reduces the emotional weight of the remaining position. By the time the third tier cleared, I was holding 7 shares that were essentially free. The profits from the early exits cover any downside from here. Currently holding those 7 shares at $971 with a trailing stop moved up to $891. After the third tier tightened. I'm coasting. If it rips higher, I participate. If it reverses hard, I'm protected at a level that still locks in a very healthy gain.
And that's the part people need to understand. The system isn't about calling the top. It's about systematically reducing exposure as the move extends so that by the time you're at these levels, you're playing with the house's money. The emotional difference between holding 10 shares at $971 with your original cost basis versus holding 7 shares with a stop at $891 and a pile of realized profit already in your account. That's night and day. One position lets you sleep. The other one has you checking your phone every 5 minutes.
The open question now is cycle stage. Is this early, middle, or late? HBM demand is going to be strong for at least 4 more quarters. Supply is not catching up fast enough to meet the artificial intelligence build-out. But Micron at these levels has already priced in a lot of that optimism. The stock went from $83 to $971 in 1 week. That's a 21% move. Even in a confirmed bull cycle, moves of that speed and magnitude usually require consolidation. They don't just keep going parabolic without a pause. My take is the thesis remains intact, but the entry window closed this week. I would not be chasing Micron at $971. If you're not in, you wait for a pullback or you look for the next setup. Chasing a 21% weekly mover is how you hand back everything the market just gave you.
And while we're on the artificial intelligence infrastructure story, let's talk about Dell. Because Dell had its best day ever this week. The stock ripped on earnings. Artificial intelligence server revenue up 757%. I'm going to say that again, 757%. That is an insane number. The volume story is legit. But here's the thing I want to flag. Margins. Bernstein put out a note, and the margins on that server revenue are running around 5 to 6%. 5 to 6%. That's assembly line economics. Dell is building the boxes, connecting the cables, doing the integration work. It's volume, not intellectual property. The revenue number is eye-popping, but you are not getting NVIDIA-style margins from that business. The market loved the headline growth, and I get it. 757% speaks loud. But if you're holding this thinking it's the next NVIDIA, you're misreading what Dell actually does in the supply chain. It's a different thesis. Valid, but different.
Agreed. Dell is the assembly line play, not the intellectual property play. The revenue growth is real because the demand is real, but the margin structure tells you exactly where they sit in the value chain. When NVIDIA sells a chip, the margin is enormous because it's their design, their intellectual property. When Dell assembles a server rack, they're competing on logistics and scale. Both can make money, but they are not the same kind of business, and they should not trade at the same kind of multiples.
All right, let's pivot to segment 3 because I want to have the debate while the energy is up. Software. Best month since 2001. That's not a typo. 2001 was the last time the software sector put up a month this strong. Snowflake had a record pop. Okta had a record pop. ServiceNow is ripping. Salesforce, ticker CRM, closed at $191.12, up 8.41% on the week. The SaaS apocalypse narrative. The idea that the entire software as a service model was dead. That narrative is officially buried. And I want to make the bullish case here before TB pushes back, because I actually think there's something real happening. The market is not rewarding growth at all costs the way it did in 2021. That's the difference. The winners this time are the companies that showed profitability and artificial intelligence integration that customers are actually paying for. Snowflake didn't pop because revenue growth re-accelerated. It popped because it showed it can make actual money selling artificial intelligence data tools. Okta is integrating artificial intelligence into identity management, and customers are paying for it. ServiceNow is doing the same in enterprise workflow. The losers are the companies that were just selling Salesforce seats or HR tools with no artificial intelligence layer. No differentiation, no reason for customers to expand their spend. This is a selective rotation to quality, not a tide lifting all boats.
I'm going to push on this because I think the distinction matters. You're right that Snowflake's pop was not about revenue acceleration. But let's look at what's actually happening under the hood. Snowflake's revenue growth has been decelerating for 6 straight quarters. 6 quarters. That is not a blip. That is a structural trend. One pop on earnings, 1 quarter of profitability does not undo the fundamental compression in the top-line growth rate. This entire software move, in my view, is a catch-up trade to semiconductors, not a new independent bull cycle. Software stocks got crushed for 3 years. They were coming off extreme pessimism. The bounce from those March lows is a repricing from deeply oversold levels. That is a valid trade, but it is not the same thing as saying we're in a new multi-year software growth cycle. The revenue deceleration is still there in the data. The market is just choosing not to focus on it right now.
All right, I'll give you the deceleration point because it's true. 6 quarters is 6 quarters. Snowflake's top-line growth is slowing. No argument. But here's why I think this rotation has more legs than you're giving it credit for. The market is forward-looking. It's not pricing in the last 6 quarters of deceleration. It's pricing in the next 4 quarters of AI-driven enterprise spending. And the company's showing real artificial intelligence revenue. not artificial intelligence hype, not an artificial intelligence chatbot bolted onto the product, but actual paying customers using artificial intelligence data tools. Those companies are getting re-rated. The rotation is real. I agree with you that it's selective. Not all software wins here. But the ones that win, the Snowflakes, the Oktas, the ServiceNows, they're not just having a dead cat bounce off 3-year lows. They're being repriced as artificial intelligence infrastructure plays. That's a different thesis than 2021 growth, at all costs. And it's a different thesis than a simple mean reversion trade.
I'll meet you in the middle on the selectivity. The winners are the ones with genuine artificial intelligence integration that customers are paying for. The losers are generic software, as a service names with no artificial intelligence layer and no reason for enterprises to grow their spend. Where we disagree is on durability. I think this move is faster than the underlying revenue growth supports. And I think a good chunk of it is catch-up from 3 years of underperformance relative to semiconductors. If I'm wrong and this is a genuine new cycle, we'll see it in the follow-through. Software names need to consolidate and then push higher, not give back half the move in the next 2 weeks.
Fair. And I'll add one thing. HBM, ticker HBM, closed at $29.18, up 3.4% on the week. That's another name in the artificial intelligence infrastructure value chain that's getting pulled along with this whole theme. The infrastructure play is broad. It's not just NVIDIA, it's not just Micron, it's the whole supply chain, from memory to servers to the software tools that make the data usable. The market is connecting those dots. Space, real quick, because there were 2 space stories this week that I think matter. SpaceX won the Golden Dome contract, that's the missile defense shield system, and Blue Origin had an explosion that effectively killed the space rally. International paper, ticker IP, closed at $33.49, up 0.51%. Not related to space, but just noting where things landed. The space defense narrative is getting real money behind it, but Blue Origin's mishap reminds you that this sector is still high risk and capital intensive. All right, quick hitters. Let's tag team these.
Kalshi perpetuals. This is a regulated binary event futures product launching in the United States. Settles to 0 or 100. No leverage. 1 basis point fee. It's a prediction market dressed as a futures contract. The infrastructure story is interesting because it opens up a way to trade economic events directly. Consumer price index prints, jobs numbers, Federal Reserve rate decisions, as binary outcomes. That is genuinely new in a regulated wrapper. My skepticism is on adoption. Prediction markets have been the next big thing since at least 2012, and they've never crossed into mainstream volume. 1 basis point fee is great, but the hurdle isn't the fee structure, it's user acquisition. Getting millions of people to open a new account and learn a new product is the hard part. If Robinhood integrates it, or if the volumes spike meaningfully next week, then we have something to talk about.
I'm more bullish on the infrastructure angle because the regulatory wrapper matters. The difference between offshore prediction markets and a regulated futures contract cleared in the United States is not cosmetic. It's the difference between institutional capital, staying on the sidelines, and institutional capital participating. Same product, different wrapper, much bigger addressable market. But TB is right on adoption. Nobody is quitting their Robinhood account tomorrow to trade Kalshi perps. This is a watch the volume story, not a buy the launch story. Gold divergence. We already hit it, but I want to name it again because I genuinely think it's the signal of the week. If the peace trade is real, gold should have fallen. It didn't. That flat 0.2% down print is telling you someone doesn't believe the narrative is finished. Watch gold next week. If it breaks lower, the peace trade is gaining credibility. If it stays flat or rises while equities keep running, the divergence widens and someone is eventually going to be wrong in a big way. What else we watching next week, TV?
5 things on my radar. First and most important, Iran deal headlines. Any sign of stalling reverses the oil and VIX moves. That's the single biggest catalyst. Micron follow through. Does it consolidate around these levels or does it gap higher? If it gaps, I'm watching but not chasing. A healthy consolidation here would actually be a better signal for the durability of the memory cycle thesis than another vertical move. Third, any PCE revision or data that shows the war premium fading or persisting. Fourth, Kalshi perp volumes. If they spike, the infrastructure story gains credibility. Fifth, the space defense narrative around SpaceX, Golden Dome, and the Blue Origin aftermath.
Also watching the wild card in the card ticker. CARD closed at $2.43, down 19.54% on the week. Got absolutely wrecked. And CPI, ticker not the index, closed at $25.20, up 0.24%. HR closed at $19.93, down 0.87%. Those names are getting sorted into winners and losers in the software rotation, and you can see it in the price action. All right, let's land the plane. Here's the show. This week, the market priced an Iran peace deal that has not been signed. Oil got hammered. VIX collapsed. Equities and tech ripped. Software put up its best month in 24 years. Micron went vertical on the HBM bottleneck thesis, and the tier system did exactly what it was designed to do. Lock profits, reduce emotional exposure, coast on free shares. Dell had its best day ever on artificial intelligence volume, but showed you the difference between assembly line margins and intellectual property margins. The software rotation is real and selective. Artificial intelligence integration winners are getting paid. Generic software as a service is not. But the signal I can't get out of my head is gold. Flat. Unmoved. While everything else screamed risk on, gold just sat there like it hadn't heard the news. The equity rally says peace. Gold says not yet. One of them is wrong, and we find out which one next week. TB, anything to add before we close?
Just this. Divergences don't linger. When equities and gold are telling you opposite stories, a resolution is coming. The market doesn't let signals like that sit unresolved for long. Next week is going to move. Stay disciplined. Let the system work. Don't trade the narrative. Trade the price action when it comes.
That's the show. Trading family, enjoy your Saturday. Go touch some grass. Spend time with people who don't know what the VIX is, and come back Monday ready. We'll be here. Peace.